Hello everybody, I'm Marcus, and in this week's stock recap video, we'll be taking a look at three main key points. The first being about Biden's ambitious infrastructure plan, the second being how Deliveroo's share price mostly tanked after a failure to list properly in the London Exchange, and we will also be talking about the potential deregulations and delisting threats against many other major Chinese companies. So to start, one of the biggest things that happened was that Biden announced his massive infrastructure ambitions. And we know that many of America's bridges, roads are aging due to poor and mediocre maintenance. And money is always very difficult to get because priority for infrastructure has not been so severe as of now. After a lot of debate in Congress and estimations by many professional analysts, the infrastructure plan was announced to be roughly $2.25 trillion. It includes around 10% of US GDP, covers the following fields, with 28% going to public transportation, including public bus and rail, 29% allocated to the improvement of quality of life at home, for example, clean water and high-speed broadband, 26% allocated to strengthen American manufacturing, in which 8% goes to non-defense R&D, 18% goes to care for elderly and the disabled. So basically think of some defense stocks such as Kratos, Strategic Manufacturing, KTOS, and other major defense suppliers for the US. These stocks may see considerable upside in the short term. And lastly, 7% will go into investment in electric vehicles, such as renewable power. And that was exactly why we saw an uptrend in some of the electric vehicle stocks for this week. For example, Tesla closed close to 10% above its low from last week, as well as many other smaller stocks such as Proterra Transition, NIO, and Plug Power also closing above their recent lows due to this huge economic announcement. But the thing is, even though this infrastructure plan was a blessing in disguise, there were many other contradictions because there's really no free lunch in this world and the money has to come from somewhere. So throughout the plan, Biden would also lift the corporate income tax to 28% from 21% and set a 21% minimum tax on global corporate earnings. As a result, the tax increases will be fully paying for the investment in this plan over the next 15 years. This was the reason why, even though there was an uptrend across many sector-specific stocks, we still saw muted performance in the major indices because many of the rich people were still digesting this piece of news. And the thing is, even though there may be a lot of liquidity pumped into all these disruptive sectors, the fact of the matter is that a higher income tax and higher corporate taxes will also mean reduced earnings and tighter profit margins for many of the larger companies, which will basically entail more muted stock growth. And the last caveat that we also have to consider is that such an ambitious infrastructure plan has never been accomplished despite the mammoth efforts taken under the Obama and Trump administrations. So this proposal would definitely face a rough road in Congress even though it has already been approved. Okay, so moving on to our next piece of key economic news this week. Deliveroo's share price dropped by more than 30% on its IPO debut day, even though it's already offering at the bottom of the range. So for context, for most companies that are going through traditional initial public offerings in the US, in contrast to listing via SPAC or listing via a direct listing, the thing about IPOs is that the investment banks underwriting the offering get to decide exactly what price to offer the company at, because the company's valuation is not a static number, rather it's a dynamic number that fluctuates in between a range. For example, a company can have around 100 million shares and can be valued between 4 billion to 6 billion. So whether the company eventually lists at 4 or 6 billion is totally dependent on the investment bank's valuation metrics and also their approximate gauge of the sentiment in the markets on that day. And the funny thing is, Deliveroo happened to be the worst possible London debut. And even though many people are blaming that the London index has much less liquidity and much less volume than the US market, but there are many other factors that may explain why the IPO was such a failure. The first thing is that many of the London investors and many of the wider European investors have this perception that growth stock sucks. And local investors would prefer companies with more predictable future, higher cash flow, and a proven business record, rather than invest in someone like Deliveroo, which has still somewhat of a shaky business model with negative cash flow and negative EBITDA margins. Secondly, the gig economy is also viewed as problematic by many European investors. Many of them were becoming increasingly concerned about the freelance-heavy business model, especially after Uber lost a similar lawsuit in the UK. So for context, for those of you who do not know what happened, Uber was forced to concede in UK's High Court that it owed many employment benefits to its employees. For example, the fleet of riders and drivers that support Uber. Because prior to that, Uber was only paying them the fees they got from delivery and was not allocating them the traditional employee benefits such as medical claims, annual leaves that were allocated by other traditional MNCs. And the thing about allocating more employee benefits and the fact that bargaining power of the employees has become stronger is also a bigger concern for a similar business model like Deliveroo itself. So the key lesson here is that becoming a tech listing hub is really not easy for the FTSE, even though London's mayor mentioned that it will be trying to relax some of the FTSE regulations to draw more investors into London. The fact that Deliveroo's IPO flopped so badly at its debut means that many tech companies would still prefer New York in the short term. Okay, the last issue we'll be talking about would be the increasingly tough threat of sanctions that are placed on Chinese companies. So to start off, we'll talk about Huawei first. So Huawei reported what could be its worst report in its past 10 years. So the Chinese 5G giant faced a series of sanctions where it was added to the US Entity List, the US Blacklist, and many other negative lists. And as a result, Huawei cannot get access to 5G, 5G infrastructure, semiconductor chips, and basically the general American population. And this is really a huge impact to Huawei's supply chain because for most Chinese companies as well as most international companies, they rely on multiple sources of downstream and midstream supply chains to ensure that their devices get produced on time. And if Huawei only has to rely on its domestic chip production system, it is unable to scale as fast as other telecom giants such as Apple and Samsung. Furthermore, the fact of the matter is that many companies are up and coming in the 5G space. So if Huawei is unable to get access to US strategic telecommunication, it is unable to implement any 5G infrastructure beyond Asia Pacific. And we see this mirrored in the stock price, where Huawei's revenue growth slowed down dramatically to 3.8% from last year's 19%, and the phone selling volume also dropped out of the global top 5 for the first time. Although the company tried to offset the impact by expanding into other businesses such as AI-powered farming technology and electric vehicles, the fact of the matter that many other telecom companies are doing the same and have the potential to overtake Huawei. Furthermore, the EV sector is also becoming extremely crowded, with close to estimated 2,000 startups competing to list for EVs in various parts of the world. So Huawei is definitely going to face a tough time marketing a product that can provide positive cash flow for the company. The blacklist of Huawei and also all the negative sanctions slapped against it is part of a broader move by Washington to curb the increasing influence of Chinese companies and also punish their shady accounting methods. And this is a reason why we saw many outflows in Chinese stocks this week. Although you can concede that Bill Huang's Archegos capital was responsible for many of the drawdown in the Chinese stocks such as Baidu and JD, many of these stocks were also facing huge retail outflows prior to Bill Huang's capitulation due to the fact that the US government continuously tries to maintain a harsh stance on China, and the best way it can do that would be through economic sanctions. Okay, so we have come to the end of today's video. Please look forward to next week's videos on some introductory lessons with regards to options, and stay tuned for next week's market recap.
Ever since the day that you went away,